This is the current stock market update for BigBear.ai, stock ticker BBAI. Before we begin with today's stock market analysis, if you find these educational materials to be helpful, please remember to click the like and subscribe buttons. Leave your thoughts below in the comments section so that other traders can find this information more easily on the platform. BBAI stock had a significant rally today of about 15%. I am referring to this as meme stock day because this was true for many of these stocks that trend heavily on social media. In other words, meme stocks. Neo saw gains of almost 10%. SoFi was a lot higher. This is pretty much true across the board. We did see some fairly significant gains, but BBAI was probably one of the best performers. And in this video, we will be looking at why exactly that happened, whether or not this means that there's a buying opportunity. Is there actually a reversal that is taking place? Or is this a better opportunity to simply short sell the stock or to just get out of the trade while there is some sort of life that's moving things higher? Clearly, the 15% rally in BBAI today does represent a significant shift in market sentiment. Previously, the stock was definitely falling quite sharply, but a close analysis of the stock suggests that while the move might be justified as a technical relief rally from a short-term basis, the fundamental outlook for this stock remains high risk, and I will be explaining why that is. I will go over the positives and the negatives because this is really the only channel that is capable of looking at the true positives and negatives of a stock like this. Overall, the justification for today's price action rests on three primary factors. Number one, removal of the financial overhang. The most concrete justification for the rally today is the cleanup of the company's balance sheet. In small cap stocks like BigBear.ai, the financial overhang, such as high debt or potential share price dilution to raise cash, often acts as a ceiling price on the stock. By largely removing this risk in 2025, you could argue that the company has transitioned from a survival story into an execution story. So as you can see, I am being positive on the stock here. Investors are likely bidding up the stock because the immediate threat of insolvency or distressed financing has been mitigated, so there is more cash on the balance sheet. Number two, speculative guidance for 2026. The rally is heavily front-running the 2026 guidance. Management is projecting revenue between 135 and 165 million, so that would be the range of the revenue projection or expectation. And even with today's gains, the stock was still down by 46% on a year-to-date basis. So clearly, the stock was priced for failure. Things were definitely getting very bad there very quickly for share prices. A 15% jump is often the market's way of resetting valuation to account for the possibility that the company might actually hit the midpoint of its growth targets. So in other words, if that were true, we would be looking at a yearly revenue number somewhere around $150 million. Number three, mean reversion and Wall Street price targets. While an average analyst price target of $5.33 represents a gain of possibly 70% to the top side, even after today's rally, with all this information, social media is able to say that the stock is currently undervalued. If these analysts are correct, that could mean that we might see 70% upside in the stock. What I do find interesting about this point, however, is that whenever the stock is crashing, people tend to say, well, don't listen to the analysts. They know nothing. They have a bias in one direction or another. People do tend to cite analysts or believe analysts whenever it agrees with their side of the argument. When a reputable financial outlet highlights the possibility of 70% in potential upside, it often triggers a momentum wave, and that does look like what we might be seeing today. Okay, so those were the positives. Now let's look at the negatives, and this is something you should be doing if you're actually holding the stock. The worst thing that can happen to you is for one of these things to be true. Why the rally may be fragile. While today's rally might be justified as a cleanup response to the balance sheet, here we're highlighting several reasons for caution in this write-up. Number one, margin collapse. Okay, so the drop from 37.4% to 20.3% in gross margins, is a major warning sign, as we can see here. Software companies are supposed to have very high margins, and this margin figure was almost cut in half. So what does that mean? The margin is the difference between the price that it costs you to produce an item and what you can actually sell it for. So what this really means is that BigBear.ai is making a lot less money for the products that it produces. For a company that has been marked as an AI leader by social media, a 20% gross margin looks more like a low-tier consulting or services firm rather than a scalable software business. I mean, if you look at successful software companies, they do not have gross margins of 20%. Those numbers are much higher. This actually starts to look like a low tier consulting company rather than a scalable software company. And this suggests that the revenue mix is currently dominated by labor-intensive contracts rather than high-margin software licenses. What they currently have would be considered to be labor-intensive contracts. So they're not making a huge amount of money on these contracts. They might have some contracts, but these are not profitable contracts. 2. Negative EBITDA. The company is still losing money, $10.3 million in adjusted EBITDA for losses just in the fourth quarter. So the company lost over $10 million just in that quarter alone. A 15% rally on a money-losing company during a period of selective federal spending is highly speculative. Okay, so this means very risky. Can you really trust the validity of a 15% rally if the business is losing money? Number 3, the execution gap. If BBAI is lagging behind peers like Palantir and Leidos, the federal AI space procurement and depth with scale are everything. So if you don't have the ability to scale your services, you're going to wind up losing money over the long term, and high fundamental valuation metrics are not justified. BBAI's 38% revenue decline in 2025 suggests that they are losing ground to these larger businesses. Okay, so in summary, today's 15% rally might be justified as a sentiment-driven recovery from an oversold state after clearing some financial hurdles. We're talking about cleaning up the balance sheet here. However, it is not yet justified by fundamental performances. 15% rally in one day is a large price move. Overall, a rally like this will only be sustainable if the next quarterly report shows a stabilization or increase in gross margins. This is probably the most important number that will be seen in the next earnings report. And you need to see a figure moving back toward 30%. I do not believe that this will be happening. You also need to see concrete evidence that Ask Sage or CargoSeer, the BigBear's software products, are actually gaining traction in the market. Right now, we're really not seeing much evidence of that. And 3, bullish investors would need to see that the Army demand recovery is resulting in actual billable revenue rather than just an intent to buy or a hope and dream for a future contract. You do not buy a stock based on the possibility that something might be seen in the future. Some sort of major contract might be seen in the future. If you're basing your investment decisions on potential contracts, you might be looking at the people that are actually gaining those contracts rather than the people that are trending on social media and may or may not be receiving those contracts. Without these fundamental improvements, today's bounce may be a dead cat bounce where the stock rallies temporarily before returning toward its downward trend, the longer term trend, after the reality of weak margins actually sets back in. In other words, overall, I do think that this is more of an opportunity to sell the stock to get out of a position like this, because you have to actually believe that several things will be coming true over the next quarter. If this does not materialize, price movements like what we are seeing today is actually your best opportunity to short sell a stock like this, or to get out of a bad position that you've been holding for too long a period of time.